The Federal Reserve just approved a 25 basis point rate cut and sees 2 more coming this year. There's no doubt this was a warranted rate cut. If you watch my other video, you would know that the job market is weakening and the Feds did need to step in to combat this problem. Jerome Powell made the announcement at 2 o'clock and the stock market loved it. It climbed pretty heavily. Usually, lower interest rates mean lower borrowing costs and more money floods into the financial market. So overall, it is a good thing and the stock market should see a benefit from it as companies will be able to invest more, make more money, and hopefully get rid of that hiring pause. If we look at the one-day time frame for the S&P 500, it was off to a little bit of a rocky start. It had a very large pullback due to the tariffs, but has regained some strength and created a pretty strong bullish uptrend. The S&P 500, the Nasdaq, and the Dow Jones are all at all-time highs. So overall, the market looks pretty healthy. Although I do believe that a slight pullback is in the horizon due to the stock market being extremely overvalued. If we look at the Shiller PE ratio for the S&P 500, basically tracks the average inflation adjusted earnings from the previous 10 years. We can see that it's sitting at a PE ratio of 39.67. This saw a large increase after the news of the Federal Reserve cutting interest rates, as a lot of optimism flooded into the market, as, like I said, interest rate cuts are a beneficial thing for any financial market. The Shiller PE ratio has already surpassed extremely high levels that we saw in 2021 of 37.97, and now it's reaching levels close to what we saw in the dot-com bubble with a peak of a PE ratio of 43.21. If we overlap the S&P 500, we can see that in 2021, when it reached that 37.97 PE ratio, the S&P 500 ended up decreasing and going bearish for a considerable amount of time. If we look at the dot-com bubble when the PE ratio was at 43.21, its all-time high, the stock market went extremely bearish and decreased considerably. So each time this Shiller PE ratio got to extreme levels, the stock market reacted and went bearish. Now, one thing that both of these time frames have in common is that the market didn't start pricing in these high valuations for at least a couple months. The market continued to drive up the price and then began to realize that this high valuation could not be sustained and a large sell-off began. This is what I believe is happening right now in the market. The market simply is just not pricing in this high valuation yet. The main driving factor of this increasing Shiller PE ratio is due to the large optimism in the AI industry. Really, every sector is implementing AI into their company in some sort of way. I began to look at the top 10 AI companies in the market right now. I made sure to add small cap, mid-cap, and large-cap companies to this list. I valued them by using 3 of the most popular valuation metrics, the PE ratio, price-to-books ratio, and price-to-sales ratio, and compared them to the S&P 500 and compared their PE ratio to the Shiller PE. The median is the best summary statistic in this table because it does not get disturbed by the outliers we see in the PE ratio. Looking at the median PE for the top 10 AI companies, it sits at 36.81. Looking at the S&P 500 PE ratio, it sits at 30.21. So these 10 companies are very overvalued looking at the PE ratio. And if we look at the Shiller PE ratio, the Shiller PE ratio is actually pricing higher than their median PE ratio. So in that case, they are somewhat undervalued. Looking at the price to book ratio for these 10 AI companies, it sits at a median of 10.32. The S&P 500's price-to-book ratio is at 5.47, 5 points higher than the median of these 10 companies, which is showing extreme overvaluation. Looking at the price-to-sales for these 10 companies, it sits as a median of 9.885, and the S&P 500 is sitting at 3.29. This is another one that shows that these 10 companies are extremely overvalued. Now, you can make the argument that this data is biased because I'm not looking at different sectors, but really these companies are the main driving factor in the market right now. Now, I want to note that just because they are extremely overvalued doesn't mean that they are not performing well. If we look at the year-to-date performance for all sectors, every single one is green. If we look at technology, 17%. If we look at the top-performing sector, communication services, it sits at 30%. Now, the reason the market has not priced in this high Shiller PE ratio is because the indexes are not showing signs of overvaluation. If we look at the Russell 2000 index, which tracks small-cap companies, they are undervalued compared to the Shiller PE ratio, as well as the Nasdaq and the S&P 500. This is why I believe the Shiller PE ratio will continue to rise and possibly reach levels we saw in the dot-com bubble. Although soon the market will retract, it just simply can't stay at this valuation for a long period of time. I think for now the market will continue its forward momentum up. Interest rates are really on the talk for the next up and coming months. So I really don't believe we'll see a retraction in the market for at least a couple months, but like I've stated in this episode, that the market just simply can't stay at such a high valuation for a long period of time, and we've seen in past historical events when the Shiller PE ratio was high, the market retracted, and it retracted significantly. If you're looking for any investments right now, I personally would stay away from the technology sector. I've shown that it is extremely overvalued. I think financial services is a good sector to invest in right now, or just any high dividend paying stocks. With the lower interest rate, companies are going to be more profitable and pay out a lot better dividend. Hope you guys enjoyed this episode. I hope you learned something new. If you have any questions, drop them down in the comment. Make sure to subscribe and like, and I'll catch you in the next episode.